Happy day, everybody, and welcome back to Mortgage Talk with Mark. My guest today couldn't make it, so I'm going to run solo today. We're going to cover a lot of different things around the mortgage world. Lots happening in my business right now and in the industry in general, so we're going to cover some things like that. Again, my name is Mark Harrison. My company is Texas Mortgage Source. I have my little banner behind me. I'm an independent mortgage broker here in Austin. I've been providing home loans for 40 years. We've done thousands of mortgages around Central Texas and would love to help you too. So I'm going to start with covering as best I can a little bit about what I call the elephant in the room right now. As everybody knows, this week the Federal Reserve met, and as expected, they lowered rates 25 basis points to 4.25. Now, everybody, well, I shouldn't say everybody, but a lot of people expected mortgage rates to follow, and they didn't. They went the other way. They actually went up a little bit. Now, people say, well, how does that happen? Why does that happen, I should say? And the myth is that the Federal Reserve has something directly to do with mortgage rates, and they simply don't. They control a benchmark rate called a federal funds rate. And it's a benchmark because it's the one that they lend to banks, commercial banks. There's lots of other indices and types of rates out there, and mortgages are a commodity. They trade what they call the mortgage-backed securities. And the better way to follow mortgage-backed securities as far as rates, trends of rates, is to follow the 10-year. Went up as well from about 4 to about 4.12. So again, the Fed controls one rate because eventually mortgage rates should be coming down a little bit. Now, I had a client who waited to close next week, thinking that this week he would get a bit better deal. And we do offer what we call a float down. So if I lock your rate in his case was 6.25, and he thought I would get 6 or under. And now, had that happened, it actually shifted and gone down, was for sure. On his, and so I protected the high side, and we could have floated down. In fact, it did come down, but it didn't. So 6.25 it is for him, which is a great rate. Now, he talked about wanting to buy it down as well. Could he invest some money to buy down the rate? And he could have, but it was going to cost him several $1,000s for a quarter of a rate. And that is if you could buy it down further. Interest rates are down about and if rates continue that trend, save your money now and use that toward when you refinance. So let's say at 5.5%, if we get there. There's no guarantees we'll get there, but the consensus is the Fed will cuts one this year and one in the first quarter of next year. And if the trend is going down, then everything will follow suit. But just because the Fed lowered rates like they did this year, didn't. So we're still in the sixes, low sixes. Now, the government type loans, the FHA and VA loans, are a little bit better because they are backed by the U.S. government as far as the safety of those loans. So lenders offer a little bit better rate on government type loans. There's some pros and cons always. But speaking of that, I just did a video on Instagram talking about don't buy a home until you find out a couple things from the seller. There's 2 things I'd like you to find out, and realtors sometimes know this and sometimes they don't. So if they don't know to ask these questions, then you find out. Find out exactly when the seller bought the home. If they bought the home anywhere from the summer of 2020 to really the spring of 2022, their rates are going to be probably under 3.5% and sometimes under 3% and sometimes even under 2.5%. We were doing loans in the low 2s for a little bit of brief window in the first part of 2022. So find out when they bought their home and what kind of loan it is, because if it was an FHA loan or a VA loan, they can be assumed. You can take over that note. So I'll give you an example. I have a client named Jake, and Jake bought a house in January of 2022. So a little over 3 years ago. His rate was 2.25%. On a $250,000 loan, something like that, I forget. And so anyway, he got transferred. Now, he couldn't sell that property because the value has come down a little. He put very little money down on it on an FHA loan, 3.5%. So the market's gone down a little bit in his area, so he couldn't sell it and walk away with any money. He couldn't sell it. Actually, he'd have to come out of pocket some money. So what he did was he found a buyer who first-time buyer, didn't have to be a first-time buyer, who decided they wanted to buy that property and put zero money into it, zero down, because they were to pick up that mortgage that he had on that property, so he could walk away with it. It's a qualifying assumption. The new buyer had to go to the servicing company who had the loan and apply through them to be able to qualify and assume that loan and take over those payments. So it was a win-win. My client got to sell the property, got out without being harmed by foreclosures or short sales. Got in with no money down or very little money and a very low rate. Nobody has 2.25 today, believe me. So that was a win-win. So find out what kind of loan they have when they bought the property, and see if they would be opened. It's negotiable. It would be open-minded to looking at maybe taking over their payment, depending on their situation. Every deal is negotiable. Every single real estate transaction is negotiable on lots of different levels. And that would be the tip of the day if I were you. Excuse me, something in my throat. And so I wanted to kind of share that because a lot of people don't know that. And if your realtor doesn't know it, showing you properties, then hopefully you'll know it. And so let's talk about, I've got a bunch of questions here in front of me because my guest didn't come up. I'm kind of thinking about what we're going to talk about today. I wanted to cover that Feds deal first because that was important. But keep an eye out. If you're looking at the trends of mortgage rates, again, look at the 10-year Treasury. You can just Google it, and investors will give you charts on that every single day, and you can track that. That's an easier way than trying to track mortgages. So let's talk a little bit about refinancing right now, because we're getting a lot of calls from people, mainly in the last couple of days, because they see the fact that the Fed lowered rates and they think automatically the rates are coming down, and they will, like we just talked about. But even said that, we're still seeing a lot of calls on refinancing. What the big question is this: what's a good time? Now, there is no magic bullet answer for that because it's hard to say. Everything, I say this a lot, it depends. I say it when I answer questions to a lot of clients, it depends, because most questions have a depends answer to it because we don't know. Now, the fact of the matter is rates are down about 1% or more from last year. So we were doing it certainly from 23. In the fall of 23, we were doing fixed rate loans in the 7.25, 7.375, 7.5 sometimes. So interest rates are down about 1 point to 1.5 points from the highs, which was a couple years ago. So if you bought a property in the fall of 2023, as an example, even through 24 for the most part, you may be in a position to refinance, depending on a couple things. And the couple of things are really this: do you have any equity in the property? Because typically speaking, they're going to ask for an appraisal. So it may be a challenge to refinance if you don't have the equity position needed, which is usually at least 5%. So if your properties come down in value, that may be a problem refinancing. But the other thing is to make sure that you look at the cost. I mean, there's going to be fees involved, and there's really no free lunch. You may hear there's free lunch out there from other lenders, that there's no cost available, and all they're doing is they're raising the interest rates to cover the closing costs. It may be a good option, but probably not, depending on how long you want to be in that home. So you may start to see some advertising either online or even your current servicing company that we're going to do a no-cost refinance. And it's possible to do no cost, but the interest rates are higher. Everything, as far as my world goes, is a function of rate and fees. The lower the rate, the higher the cost. The higher the rate, the lower the cost. So you may start seeing some advertising around that. A rule of thumb is, in the old days, when I got in the business back in the 80s, our loan amounts were so low. Our average loan amount in 1985 was $70,000. Think about that in Austin, Texas, $70,000. You could buy a nice home for $70,000. But anyway, if rates were to come down, because its loan amounts were small, it was hard to justify the fees, the title costs, the lender fees, the attorney cost, appraisals possibly. So there's usually the same set of fees, even a little bit higher, because title policies are going to be charged again to you in Texas. Now, they will discount those, depending on how long you've been in the house, but you're going to have a series of closing costs, could be $4,000 or $5,000. So you want to make sure that you're getting, what the payback is. If you're saving $200 a month, that's going to be 25 months that you would have to be there in order to gain those dollars back. So if you're going to be in a property 3, 4, 5 years after a refinance, it may make sense. The other thing is timing. We don't know what's going to happen in the future. I expected, and like most of my peers expected, in the markets in general, that rates would have been lower by now, lower than they are currently. We're talking about that a couple years ago, but has been chairman of the Federal Reserve, and so one of his committees decide on the direction of the federal funds rate, which is the thing we've been talking about. And so he's been pretty conservative. I don't think he's big on Donald Trump, so he's not doing any favors as far as lowering interest rates, which would be a boom for the economy in lots of different reasons, not just mortgages, but car loans, credit cards, home equity lines of credit, personal loans, student loans. There's lots of things that trend with the Federal Reserve. So if they were to lower rates, let's say a point, then fixed rate loans in the mortgage world would probably be around 5.5%, which would be ideal for a lot of folks to refinance that have bought in the last 3 years. So that's something to consider, is timing and also the cost and the savings too. Now, speaking of that, most people over the years have come to me to refinance, including myself. I've done this on several properties of my own, is to go back to a longer term loan, let's say a 30-year mortgage, as opposed to, because you can save the money because you're going back to a longer amortization. But what I like to illustrate to you, in the old days, we didn't have a lot of options. We had a 15-year mortgage and a 30-year mortgage. Now we can amortize a loan over any year up to 30 years. So you could do a 28-year mortgage, you could do a 23-year mortgage, or 18. So there's lots of different options these days. So we want to back into what makes most sense, short term and long term, because the shorter term of the amortization, the more equity, or the faster you're going to build your equity, because you're paying down that loan quickly. So that's something to consider as well. But call me on that. My number is 512-789-6967. And we can take your particular situation, work the numbers, and see if it makes sense for you either now or hopefully in the near future. And let's talk about a little bit about the difference. If you're buying a property, you're going to hear some terms as well called pre-approval or pre-qualified or pre-approval. What's the difference? I'm going to kind of go through that to make sure you're clear, because if you were to contract on a property, the seller is going to want a letter from either me or whoever you're using for your mortgage, some level of qualification that they verified your income, that they verified your credit, that they've verified your assets. That's being what they call pre-qualified, where a lender like myself would take in some information over 2 years. Could be tax returns if you're self-employed, or you're on commission sales, or you have other types of income like Social Security. We're going to ask for tax returns. If you're straight W-2, then we don't need tax returns. Or if you own investment properties, they're going to certainly want to see tax returns. So, but straight salary people require 2 years of W-2s. We require a couple months of bank statements to show your asset base, whether it be 401ks or IRAs or savings or stock or whatever you have available liquid. And then, of course, your credit. And once we verify that, we run everything through an automated system. You know, AI is the big tool these days, but everything has been running through an automated system for several years. It's called DU, Desktop Underwriter. That doesn't matter. But once DU approves it on the computer, you're what they call pre-qualified. You're qualified via a computer, okay, which is usually a very, very strong case to be qualified. However, the next step around that is to be pre-approved. So if there's situations on your credit or other documentation that we want to be sure of, then we will actually send it to an underwriter and sign off on it as an approved loan, just like it would be. And this is before you contract. So you want to get pre-approved. I've got 2 of those in process now. One of them is a good friend of mine, and he's paid differently on because of his type of work he does. And I want to make sure that the underwriter agrees with my assessment on how it's supposed to be calculated in order to get him approved. So when he's going to be beyond pre-qualified, he's got some time. His lease doesn't run out until December. So we've got a little time to get him pre-approved. And that's even a stronger position, because once you're approved for a loan, we can close very quickly. So if he wants to contract with a seller and the seller wants out fast, so we can usually do that in a couple weeks once you're under contract and you're pre-approved. So that's something to consider as well. And then there's a question that comes up a lot around down payment. You know, how much money is the optimal money to put down for a mortgage loan? Now, again, it goes back to being, it depends, because it depends on your qualifications in general. Typically, conventional loans require a minimum 5% down. There are some special programs for first-time buyers that allow you to put down 3%. And my client I was just talking about, who's going down with a 3% down loan, um, and but his interest rate was very good because his credit was very good. His credit scores were about 800, which is very high on the FICO chart. So he got 6.25% with no points. There was no fees for that rate. That was what they call it, a par rate. Now, 3% down at 6.25 is very good. Now, if his scores would have been let's say 700 or under 700, his rate would have been much higher. Because lenders have the thing called loan level pricing adjustments. We call it LLPA, loan level pricing adjustments, which means that the loan level is how much are you putting down and what is your credit score. So obviously, the more you put down, the better deal you're probably going to get, unless your scores are very are low. And I mean low in conventional financing, probably be in the mid 600s. Now, the mid 600s on an FHA loan is perfectly fine. FHA is designed typically for people that have, it's a little bit easier loan to qualify for on two levels: on debt to income, how much you owe on other services besides your mortgage loan, and your credit score. So FHA is usually designed for first-time buyers that maybe just getting started out, maybe don't have a strong credit history, but can have a job and they can qualify. So there's definitely some pro to FHA loans. Plus the interest rates are better. Okay, now the reason I didn't go FHA with my client Tyler was because I got him 6%, 6% on an FHA loan at the time, but FHA has levels of what they call mortgage insurance, which didn't make much sense for him to be paying long-term mortgage insurance when he was going to be in a position here the next couple of years to pay down that loan and waive whatever mortgage insurance he had. That's the other thing about conventional loans. It's also this loan level pricing is based on credit scores on what they call the mortgage insurance premium as well, or PMI, private mortgage insurance. So his case, it was only, I think, about 35 or 40 bucks a month. It wasn't much because his credit scores were so high. So depending on what kind of loan you qualify, of course, if you're a veteran, you don't have to qualify for any down payment. There's no down payment required. And speaking of VAs, I was up in Temple this week with a friend of mine who's a realtor up in Temple, and he's a retired veteran. He was in the service for 15 years or so, and he's been in real estate about 8 years. He's about 40-something years old. He's a friend of mine who works mainly with veterans up in Temple, Belton, Killeen, Coppers Cove, in that area. And we got on the subject of refinancing because he's thinking about refinancing himself because he bought a house a few years ago, and his rate is 6.8%, which isn't horrible. But I said, look, Matt, we can get you a better deal today for sure, probably in the high fives, and without qualifying. See, the VA loan has a special refinance function, if you will, that's called an EARL, which is it's a streamlined refinance. You don't need an appraisal done. I said, Matt, we don't need to appraise your property. We just need to make sure you've made your mortgage payments for the last 12 months timely. If you hadn't, that's the problem, but he had. So I said, we can streamline your refinance, get you that new rate in the next 3 or 4 weeks pretty easily. And you even get to skip 1 month. So if he were to close it, and he hadn't decided, but if he wants to close in October, he would skip November payment altogether and make a December payment. So we're working some numbers for him on what they call a VA EARL. So if you have a VA loan, it may be a good solution for you because there's no appraisal required. So if his property had come down in value a little bit, it wouldn't matter because they don't require an appraisal. So that's something to consider if you're a veteran. And I think I've mentioned this before on the show, but Texas has the second highest number of veterans in the state besides California. So there's lots of veterans, especially in Central Texas between San Antonio and Killeen, with all the Air Force bases and the Army base and things like that. So let's talk a little bit about closing costs. And we mentioned those a little bit around refinancing, but in general speaking, when you buy a property, there's 3 buckets to consider of money. Just because even on a VA loan, say it's zero down, but there's still closing fees to be paid. And generally speaking, the seller will pay those for the veteran, but they could run $4,000 to $6,000. Okay, but something that you really want to consider looking at is, what is the lender charging me for this loan? When I say the lender, I mean the mortgage companies themselves, any any third party, have fees like processing fees and underwriting fees, admin fees, things like that. There's all sorts of names that lenders call their charges. But then there's also fees that from the title company. How much is a title company going to charge me to close this loan? It used to be not used to be $400 to $500. Now I've seen some as high as $700 just to close the loan for the buyer. So and usually the client doesn't know that, the borrower doesn't know that, because it's usually chosen by the real estate agents. So make sure that your title company is not only good, but they're going to do what they say they're going to do, but they're not going to charge you a whole lot, or too much. It's a reasonable fee to close the deal. Then there's also other fees that are regulated by the state of Texas in the title work, and that will be the same regardless. But there could be things like appraisal fees, survey fees, recording fees. Some of this is regulated in the same, but some is going to change. Usually the lender fees are the ones that are going to change the most. So make sure that you negotiate the best deal you can, because I tell everybody, everything is negotiable. Within reason, everything's negotiable. So usually you can look at a lender fees between $1,000 and $1,500. That would be sort of the cost that they're going to charge. Now they also make money on the loan itself. That's why I stress this strongly to actually really shop for your mortgage to get the best deal, because they're making money up front, and then they're making money what we call in the back end. And the higher the interest rate, the more money the lender is going to make. And they don't show you that. They don't tell you that, what that number could be. But that could be up to 3 to 4% of your loan amounts. If you borrow $300,000, that could be $9,000 to $12,000 they're making down the road. Okay, you say, well, that doesn't matter to me because it's not out of my pocket. Well, they're building it into the interest rate. So the lower the rate, the lower they're going to make. So that most lenders have incentive to charge you the highest rate that they can. So be very careful when you talk about interest rates with lenders, and always ask, we talked about this a couple weeks ago, the APR. What is the annual percentage rate on this mortgage, including all the closing costs? And we're also starting to see a lot of investors coming around, and I'd like to talk a little bit about how to buy investment properties, because there's lots of options for people, whether you're self-employed or you're a W-2 employee. The best rates that you're going to find in buying investments, here's what I recommend if you don't own a home, obviously, is to buy your first home. If you want to put down the minimum, you can, because most investment loans require 20% down or more, depending on the structure of it. But you could buy, again, a homestead or owner-occupied property and put down 3%, 5%, 3.5%, something like that, and stay there for a year, unless you want to stay there forever. But if you want to buy another property, I would go ahead and probably lease that property out that you live in, and then buy another home. And you could buy another home and again put the minimum down. You don't have to buy, because you're going to be living there. You could still get the lower down payment and the preferred interest rates. Now, here's a kicker. If a property you buy is currently rented, and this is happening to me right now with a client moving from Arizona. She's going to move here and live there, but she's got a couple of properties to sell in Arizona first. So the current owner is going to lease back the home for 6 months, because they're building their own home. Okay, because she's not going to live there in the first 60 days, we had to structure that loan as an investor loan, which cost her quite a bit of money. But I said, Lori, if you're not going to live there within 60 days by Texas rules, Texas law, mortgage law, that property is going to be designated as a investor type loan, since you're going to rent it out to the seller, even though your intention is to move in that property in 6 months. She was disappointed, but I said, look, your goal, because you're retiring, is you're going to sell these homes and pay this loan off anyway. So you're only going to be penalized for like 6 months of payments, 1%, if you will, higher. And she was okay with that. But that's something to keep in mind. If you're looking to buy a home and a tenant's living there and they're on a lease for 6 more months, that could be a problem, because you're going to have to, unless they're willing to move out, and they may, but if you buy a home that's currently rented, leased out, most likely you may have to put more money down, and that would be something to consider. And so make sure you understand how that works, because in Texas, the deed of trust says you're going to live in there and occupy that property within 60 days of closing. But there's other types of loans. One is called a DSCR, which stands for Debt Service Coverage Ratio, which means that you don't have to qualify for the mortgage. The property has to qualify. So I bought a house, actually a mobile home out in Smithville one time, and we put down 20%, but we didn't have to do tax returns and all that because we could show per the appraisal that the property would rent for what the monthly payment is. So let's say a property rents for $2,500 a month, and when you buy that home, your mortgage payment is $2,500 a month. It's a 1-to-1 ratio. The rent is going to equal what your payment is going to be. So the lender does the loan on that. They don't care. They do care about your credit, and they do care about down payment. They don't care about your income. They're not qualifying you. They're qualifying the property. Your qualifications are based that you have the money to put down, which is usually 20%. And your credit scores aren't below 640. They don't like to see anything over 640. And again, just like any other loan, the higher your scores, the better deal you're going to get. Now, in general, these rates are going to be higher than you can get in the traditional market. But for a lot of people who couldn't qualify for different reasons by their income and their debt to incomes buying a property, then the DSCR is a great option for people because most likely they're going to put down 25% anyway, 20 to 25% anyway. So that's kind of what I had today. There's a lot of moving pieces in my industry. If you got any questions, please, again, reach out. My number is 512-789-6967, or my website is markhairston.com. Again, I'm an independent mortgage broker, Mark Hairston, Hairsto.